Hello and welcome back to our job order costing notes. And so we are resuming this lecture video on page 24 of your notes for job order costing. And we're going to do another practice problem here with journal entries. Okay, and this one actually goes on from page 24 to page 25. What would probably be a good idea is if you can do through number 5 on your own, and then just pause this lecture video and then come back and check your work, and then we'll check it, and then we'll do numbers 6 and 7 together. That would probably be the best way to do this problem. Okay. But anyways, I'm going to go ahead and go over it. Okay, so I'm going to go a little bit faster on this one than I did on the other practice problem, just because this is the second one that we're doing. So purchase raw materials on account, debit to raw materials, okay, for $18,000, and then we credit AP, accounts payable, for $18,000. Issued materials and supplies to production, job 101, 102, 103. You don't need to add, you don't need to say WIP, comma, job 101, WIP, comma, job 102. It just all goes into work in process. And again, similar to manufacturing overhead, they're going to be tracking this on a more detailed level with job cost sheets. Okay? But it all just goes into WIP, debit to WIP for adding up all these $14,000, the 4 plus the 5 plus the 5, $14,000. Indirect materials goes to manufacturing overhead, and then I credit raw materials, okay, for the summation of the $15,000. Okay. We look over here, accrued payroll. Again, this is direct labor, and this is indirect labor. So the direct labor goes into WIP. I add the 6 plus the 8, it gives me 14. So I have my $18,000, and then I'm going to debit manufacturing overhead for $3,000, and then I will credit wages payable for $21,000. This next one, incurred other overhead costs during the accounting period, depreciation $5,000, miscellaneous overhead incurred and paid. So this is overhead, so this goes into manufacturing overhead. Debit to manufacturing overhead for $8,000. Credit accumulated depreciation for our depreciation of $5,000. And then it said other overhead incurred. Anytime you see that, that's a credit to cash. Credit to cash. Okay. The next one that I have right over here, it says our factory overhead is applied using direct labor cost as the allocation base. And here is our estimated total overhead and our estimated total allocation base. So we take, first thing, we have to calculate our rate. 100,000 divided by 200,000 gives me 0.5. And I'm going to have to come down here with number 5. I'm running out of room. So then 0.5, let's continue down here. This is saying we apply 50 cents of overhead for every direct labor dollar. So how many direct labor dollars do we have? 18,000. So that means 18,000, which is the amount of overhead that was incurred by those jobs, times our predetermined overhead rate of 0.5 gives us $9,000 of manufacturing overhead applied. The journal entry to apply overhead is a debit to WIP and a credit to manufacturing overhead. Okay? And then finally we come over here and it says jobs 101 and 102 are completed. So in order to do that, we actually have to do our job cost sheets for jobs 101, 102, and 103. So we look over here, and we have to look for some beginning balances. And it says our WIP for job 101 is $2,000. Beginning balance for 102 and 103 is 0. Okay? And so then now what we can do is to start to complete our job cost sheets right over here. So if you look over here, our WIP for job 101 is 4,000. I'm sorry, materials for job 101 is for 4,000. And then for job 102 is 5,000. 103 is 5,000. Okay. In our direct labor right over here, 6,000, 8,000, and 4,000. And then we have to add in our direct labor. Remember that our predetermined overhead rate is 50 cents. So for every direct labor dollar that we have, we apply 50 cents of overhead. So that means 6,000 times 0.5, 3,000, 4,000, 2,000. Okay? And we can add up all these, and this would give us our total cost of $15,000, our total cost of $17,000, and our total cost of $11,000 right there for job 103. Okay? Now we can resume back to our journal entry for number 6. Jobs 101 and 102 are completed during January. So I'm going to flip the page over and do this. And so that means jobs 101 and 102 are completed. So we completed 15 plus the 17,000, $32,000 worth of jobs. Recall that when a job is completed, we move it from work in process to finished goods. Those are both asset accounts. So one asset account, finished goods, is going up. The other account, the other asset account, work in process, is going down. So our journal entry is a debit to finished goods for our $32,000, and then a credit to our work in process WIP of $32,000. Okay? That is number 6 right over here. Then we look at number 7. It says job 101 was sold on account for $20,000. And so remember, we have to do 2 journal entries. So this is number 7. And I'll move it up here. It was sold on account. So remember, that means a debit to accounts receivable for $20,000. And then a credit to sales for $20,000. That's the first journal entry. The second one is to recognize the cost of goods sold. And so this is the cost of goods sold at $15,000. So I'm going to debit my cost of goods sold, $15,000, and then I will credit finished goods for $15,000. And those are my 2 journal entries. Now what we can do is we can look at our T accounts here as well and go through and relate some of these T accounts to calculating cost of goods manufactured and cost of goods sold. So you look over here, it says we did have a beginning balance of $1,000 in our raw materials account. And then following through with our journal entries, we purchased another $18,000. Okay? And then what we had over here, we credited raw materials for $15,000. Remember, $14,000 went to WIP, $1,000 went to overhead. We got $15,000 right over here, which means I have $4,000 of raw materials left over. This would show up on the balance sheet if this was the end of the accounting period. We would see this in the current assets section of the balance sheet. And then what I can do is go ahead and do my WIP. So I've got my $2,000 beginning. And then look, debit to WIP, $14,000 for my direct materials. Another debit to WIP for $18,000 for my labor. Okay. And then I have a final debit to WIP down here for $9,000 for my manufacturing overhead applied. Okay. And then what I had, if I flip the page over, we credited WIP for $32,000. So I put $32,000 over here. And I can calculate the balance and work in process by adding up all these and subtracting 32. And when I do so, I get $11,000. And that number should look familiar. That's job 103. And it stays in work in process because if you look at 6, it says jobs 101 and 102 are completed, but not 103. So that means 103 stays in ending work in process. Okay? Then we come over here to finished goods. We have 0 beginning balance for finished goods. And then what we had was $32,000 that we added to finished goods. And then we credited finished goods right over here. 32 minus the 15 gives us the 17. That is job 102. Job 102 was completed, but it was not sold. This is job 101, which was sold. We do our T account over here. We had our $15,000. We had our wages payable of $21,000. And now let's go ahead and look at our manufacturing overhead T account. Okay? So you look over here, we had a debit to manufacturing overhead of $8,000 for other. We had a debit to manufacturing of $1,000 for indirect materials, $3,000 for indirect labor. And then if we look down over here, we credited overhead for $9,000. So what we do is we can add up all these. We can add the 8 plus the 1 plus the 3 gives us 12. 12 minus the 9 gives us $3,000 left over in manufacturing overhead. Now, why is there a difference? There's a difference because this is based upon an estimate. Remember, we want to use estimated overhead divided by estimated allocation base, and the reason that we use an estimated rate, or a rate based on an estimate, is because for pricing purposes and for budgeting purposes. So the credit side of the manufacturing overhead T account is for the estimated, the applied overhead. The debited side over here for our T account, this is the actual overhead incurred. Okay? So what this is saying is our estimate was off. Our estimate was wrong. We actually have $3,000 more overhead than we thought that we would have. Okay? Or that we applied. And so we need to talk about what we're going to do with that. Okay? So at the end of the year, we actually have to do something with this manufacturing overhead that's sitting in that manufacturing overhead T account. We have to do an adjusting journal entry to zero out the manufacturing overhead account. Okay? So look at this in terms of our T accounts over here. I'm just going to go ahead and follow what I had before. Remember, I had that $1,000 indirect materials, $3,000 of indirect labor, $8,000 of other, $9,000 applied. So what we have is our $3,000 debit balance left over in manufacturing overhead. So what we need to do is we need to get rid of this. Okay, so that basically means we're going to put a credit to manufacturing overhead. Okay, well, let's talk about underapplied versus overapplied overhead. Underapplied overhead is when the amount of overhead applied, right over here, is less than the actual overhead that we have. So this is an underapplied overhead situation. And again, the reason that we have these discrepancies is because the overhead that we apply is based upon an estimate. It's estimated overhead divided by estimated allocation base. We use an estimate for pricing and for budgeting purposes. Okay, so our estimate was off. Okay? Our overapplied overhead, on the other hand, when the amount of applied is more than the actual, it's greater than the actual. So if this were $15,000, I would have a $3,000 credit balance over here in manufacturing overhead, which would mean it's over applied. So credit balance in manufacturing overhead at the end of the accounting period means over applied. Debit balance in manufacturing overhead at the end of the accounting period means under applied. So again, what we're actually going to have to do is at the end of the accounting period, typically the end of the year, we will need to do a journal entry to get rid of this. So basically, zero out this manufacturing overhead. Okay? There's two methods. The first one is to close to cost of goods sold. The second one is to prorate among finished goods, WIP, and cost of goods sold. Okay? So I'm going to end the video here, and then the next video we'll talk more about manufacturing overhead. Thank you.